Hey guys, welcome to another video. Thanks for joining me. In this video, I'll be talking about bonds and how we can use bonds to diversify our portfolio and basically have a good understanding of what bonds are and how it can be beneficial for any investor, especially if used appropriately. If you're new to my channel, thanks for joining me. And on my channel, I talk about saving money, investing money, and how we can maximize use of our money through passive income. So if you are interested in subjects like that, please consider checking out my channel. And if you find what you like on it, please consider subscribing to the channel. And also, if you like this video, please consider giving this video a thumbs up. So a good example is this. Let's assume that there's a company that is looking for ways to raise funds. Well, they can do a couple of things. They can go to a bank to borrow some money, they can go to government bodies to borrow some money from them, and they can go directly to investors to get money from them. Now, one of the things that you need to understand is that banks often have a limit of how much they can give to a corporation, because at the end of the day, the bank is also trying to diversify its investment. Now, the thing is that a big company, for example, may need a lot of money, and in order to secure that money, they often need to open their investments to the investors like you and I. They may often either sell stocks, which in that case, if you buy a stock of that company, you own an equity in the stakes of the company pretty much. And you're entitled to sometimes maybe dividends and also price appreciation of the stocks. If you're interested in a video like that, I've shared a video about it up above. But after this video is when you should do that. Bonds are basically debt obligations that you as an investor will definitely have a right to your money in the future, which means these corporate bodies or government or corporations will use this money to meet their own demands, and they will pay you a certain money over the time up until maturity, which they will return your money back to you. So just to give you a good example, let's say you bought a bond of a company that is selling for $1,000. In the bond information, we'll tell you how much they're going to pay you till maturity, which in this case, it's called the yield to maturity. Now, this yield to maturity, let's say it's 4%. Well, in that case, that means over the course of time, this corporation will pay you 4% of that amount every year up until maturity, in which they will return your $1,000 back to you. Now, one thing you need to understand is that you do not have any equity in the company and you have no right to dividends. So what will end up happening is that if the company makes a lot of money, well, they won't pay you more than what they already promised to pay you. So this sounds like a good deal to any form of investor. Well, because remember, if the company also loses money, then the company is still obligated to still pay you that same coupon rate or that dividend yield. Every company has a bond rating. Just like we have a credit rating, these companies also have a rating. And this is done by three bureaus. We have Moody's, we have Standard & Poor's, and then we have Fitch. Now, these bond ratings are basically issued through these bureaus. And what they do is that they investigate the bonds and investigate the companies to make sure that the bonds they are securing are going to be backed by, the operations of the company in terms of their finances and their ability to repay and also pay the coupons that they promised to pay. So these bureaus classify these bonds in three levels. We have the investment grade bond, we have the non-investment grade bond, and then we have the junk bonds, or in this case, high risk bonds. If you look at the investment grade bonds, you realize that the classification of these bonds in terms of their ratings are the same across the board, even though the letterings and the designations given to them are slightly different. At the end of the day, these all classify as investment grade bonds. On the other hand, with the non-investment grade bonds, it's the same. And it's your duty as an investor to investigate and look at the prospectus of these bonds before you invest. Because here's the reason. If you are investing in investment grade bonds, what happens is that these investment grade bonds would often pay minimal interests, all right? And that is because they are considered safe and they have very good credit worthiness. On the other hand, with non-investment grade bonds or the junk bonds, these are considered high risk bonds, and especially with the junk bonds, they have a tendency to default, which means in order for an investor to buy their bonds, they need to offer very high returns. Now, you need to understand that there are different types of bonds. We have the zero coupon bonds, we have government bonds, we have treasury bonds, we have corporate bonds, municipal bonds, and so on. There's so many types of them. Now, at the end of the day, they often have different risk levels associated with them. And that is why it's very important to look at the bond ratings in terms of how suitable these companies are or government bodies are to refund and keep to their obligation. Now, you need to understand that the different risks associated with bonds. First I'm going to mention is credit risk. You need to understand that because you are giving your money to this company has a chance of defaulting, and that means they may not be able to pay you back your money. But the only thing that you have going is that these companies are obligated to pay you ahead of the shareholders. Well, because it's a debt that the company needs to repay and they promise to repay, Even if they sell their assets, they are required to pay the bondholders first before paying the shareholders. The second risk with any investment is inflation risk. You need to understand that if inflation keeps going higher, well, your actual rate of return is decreased. For example, if the bond is promising to pay 5%, but inflation increased to about 3%, what you end up getting back in terms of the worth of your money is only going to be 2% increase instead of 5% that you thought you're going to get. So you always need to keep that in mind. Now, the next one you need to understand is liquidity risk. You need to understand that any form of buying and selling will often face liquidity risk, because what if there's no one willing to sell when you are ready to buy? Or what if there's nobody willing to buy when you're willing to sell? Which means that your price that you think you would get is probably not going to be matched. If you guys trade stocks properly, you know that there's always a bid and ask prices, and often there's always a spread. If there's less demand for the bond that you're willing to sell, well, you might not be able to execute it at the price that you desired, which means you might either not be able to sell at all, or it might execute at a price that you didn't plan for. Now, one thing you need to understand is that interest rate risk affect bonds. Just for an example, let's assume that a bond was issued today. This bond is assigned, say, 2% yield to maturity. A year from now, if the Feds decide to increase interest rates, and interest rates goes to maybe 4%, people will be attracted to buy bonds of the same value, of the same credit risk. People will prefer to buy the bonds that is given 4%, which means in order for me, assuming I bought the one issued right now in this market, in order for me to be able to sell, I will need to sell mine at a discount to another investor. On the other hand, let's assume that interest rate further decreases. Right now, let's assume a bond was issued 2%, and then a year from now, the bond issued, the yield to maturity on those bonds is now 1%. Well, in that case, the bond I'm holding right now is more valuable, which means in order for me to sell, I will need to sell at a premium, which in that case, the buyers that are buying then will have to pay more money for me to sell, which means it favors me, but at the end of the day, the face value will still be the same, if that makes sense. Because remember, if this face value was $1,000, at the end of the maturity, they'll still get $1,000. But the only thing that will be different is the yield to maturity based on the amount paid for that bond. So the question is this: why would anyone want to buy bonds? One of the ways you can often diversify your portfolio is through investing in bonds. A bond, like I said, is a fixed income asset. And by having these bonds in your portfolio, it would often help to supplement the income that you receive in your investment. And at the same time, it will help to reduce the volatility of your portfolio, assuming you have stocks in that portfolio. Now, in my situation, I plan to invest a certain amount of money in bonds. And that is because I want to diversify my asset even more. So the question is, should you be buying bonds in this environment? Well, the thing is this: if you're going to be buying individual bonds, then you might have a big problem. And that is because you have to do your investigation, bond ratings, see your yield to maturity, and you're probably going to be buying a bond that won't be able to perform well because interest rates are very low right now. So which means the yield to maturity on those bonds will be very low. If you are considering investing in bonds, my suggestion is often to look at index funds or mutual funds. The reason is because when it comes to selecting the winning fund or bond, it could be difficult, especially as an individual investor like us. But by investing in index funds or mutual funds that hold bonds, you stand a chance of diversifying your asset. And at the same time, these assets are generally invested in other bonds that could often be short-term, long-term, or intermediate-term bonds. Now I'm investing in this Vanguard intermediate-term bond. And like I already talked about, intermediate bond generally will last between 3 years to 10 years. And this particular one has an average duration of about 6.4 years. All right, if I go here under the portfolio management, you can see it tells us the ratings of the bonds that are invested in this case, the AAA, the AAA, and the BAA as well. You can tell that, almost half of the bond is in the US government bonds. However, there's some of it that is also invested in other ones, like in finance, like in industrial, like in treasury agency, obviously, which is generally the government related bonds, and also tells you like the duration of the bond itself based on the holdings it has. In this case, most of it is in 5 to 10 years, and that's why it's considered an intermediate term bond. And one thing that I want to pay attention to is that the yield to maturity is very low right now, and that is because bond prices have gone up. All right, especially remember, like we said, that if you had these bonds, let's assume that these bonds were issued, say, last year, interest rates were higher, but now interest rates have dropped. So what happens is that in order for me to buy these bonds, I would have to pay higher prices for them. Now, the question is, should I be buying now or should I be waiting? Hey, it all goes back to just like trading the stock market. Sometimes you think the price is high. However, you realize it keeps going up. But one thing for sure is that we know that the Feds will increase interest rates sooner, which means at some point, if you hold it long enough, these prices will, almost equal out in a way. Now, if I was trying to time the market, then obviously this won't be the best time to be buying. But because I'm not timing the market, this is why I'm going to go ahead and just invest it. And that's it. I hope you found some value in this video, and I hope that you've learned something in this video. Consider subscribing to my channel. That definitely helps my channel if you're still here. And also, please consider giving this video a thumbs up. Definitely encourages me to keep doing what I'm doing. If you have any questions, please leave them in the comment section below. I would like to answer them if I can. So I do appreciate you watching this video, and I'll see you in my next video.